If you're earning over $200,000 a year, there are passive income opportunities available to you right now that the ultra wealthy have been using for decades. And chances are you've never even heard of them before. These aren't flashy investments. They're definitely not talked about on CNBC. They're not on Mad Money with Jim Cramer. And your financial advisor probably isn't bringing them up either because they can't make fees off of them. But they're real. They generate predictable contractual cash flow every single month. They come with better tax advantages than stocks or bonds, and they're used by family offices and high net worth investors to quietly build wealth behind the scenes. And in today's video, I'm going to break down 3 of these little known passive income strategies, what they are, how they work, and how you can use them to start building a portfolio that actually sends you checks, not just paper gains. For those of you who are new to the channel, my name is Danny Gould. I'm the CEO of Gould Capital, and over the last decade, I've overseen over $250 million worth of real estate transactions and was also co-managing partner of a $300 million hotel portfolio. In that time, I've interfaced with some of the wealthiest and the smartest investors in the country, and that's why I created this YouTube channel to share with you the ultra wealthy's investing secrets. So let's get started. And the first thing I want to make perfectly clear here, there is a massive difference between passive investing and passive income. If you're invested into an index fund or you own a portfolio of stocks, that is not passive income, it is passive investing. Now, most high earners here in the United States have been told that they're doing the right thing. Max out your 401k, buy some ETFs, invest into the index, buy some stocks while you're at it, some high growth stocks that you think are going to make you a lot of money, and just ride the market. But that strategy really provides little to no diversification, almost zero tax benefits, and no cash flow. But what the wealthiest Americans understand and what they strive for is to replace their active income with passive income as quickly as possible. Why? You can then live off the passive income and funnel more and more of your active income into more investments. You can never replace your active income with passive income if all you're doing is investing into the S&P. And even if you're invested into dividend stocks, if you make multiple 6 figures and you need to replace your active income with passive dividend income, you're going to need 8 figures worth of dividend stock in order for you to make that up and replace your active income. That would literally take decades of disciplined investing to do. And there's a reason that you've never really heard of anyone who's done that before. I can assure you that of all the ultra wealthy Americans that I've had the privilege to interface with, not a single one has replaced their active income with dividend stocks. So now that you figured that out, now that you understand that investing solely into stocks isn't going to help you replace your active income, what do the ultra wealthy invest into for cash flow that they can actually use? Well, very simply, you need to invest into assets that produce cash flow. This isn't going to be another real estate video. We're not going to talk about syndications and funds. I have plenty of other videos on those subjects. Today, we're going to be talking about 3 more under the radar investment strategies that produce a tremendous amount of free flow in cash and are also collateral-backed private investments. So let's get started. First up on the list is private credit and asset-backed lending. Private credit is exactly what it sounds like. Instead of giving your money to a bank, you become the bank. You're lending directly to small businesses, real estate sponsors, medium-sized businesses. The list goes on and on. These loans are going to be secured by hard asset. If it's a real estate deal, obviously the loan is going to be secured by the real estate. Or if it's a small business, maybe they own some equipment, receivables, and those are the assets that are going to be put up as collateral. Then as the creditor, you're going to be collecting interest. You receive monthly or quarterly checks, and there's going to be a contractual repayment schedule. It's just like any other loan. Now, in the business world, for small and medium-sized businesses, looking for private credit doesn't necessarily mean that they're in trouble, right? So maybe as an investor, you're thinking, well, why would I want to get into a private credit situation if they're in trouble? Well, a lot of businesses don't have problems financially if they need private credit. They might have cash flow where they have a bunch of accounts receivable. They have money that's coming in, but that money's coming in maybe 6 weeks, 8 weeks, 12 weeks out, but they've got salaries to pay right now. So there are lots of cyclical and seasonal reasons why businesses might need private credit lines that have nothing to do with the health of the business. Now, in real estate, private credit can be used for a whole slew of things, including construction loans, bridge loans, mezzanine debt, second position notes, and the list goes on and on. And the reality is there's a big market for these types of loans and credit lines. Now, the great thing about these types of investments is that they are collateralized, which means that as an investor, you have a tremendous amount of downside protection. If anything falls through, there is obviously an asset that is backing that loan. Not only that, but these notes are typically structured with floating rates, which means that there is a natural hedge against inflation. If rates go up due to inflation, that floating rate will also adjust up, and it'll help keep your investment margins safe. In a market where volatile stocks are swinging 20% a year, private credit can quietly pay you 9 to 12% like clockwork. While the average dividend stock pays you maybe 1 to 3% annually on your investments, these private credit deals can pay you anywhere from 8 to 14%, which means that instead of $10 million to get $200,000 in cash flow from dividend stocks, you might only need to invest about $2 million into these types of opportunities to provide you with about $200,000 in free flowing cash every year. Big difference. It's consistent, it's reliable, and backed by real assets. Next up on the docket is preferred equity, or pref equity for short. Pref equity is like being a limited partner or a silent partner in on a deal, but you get paid before all of the other partners, hence preferred equity. Got it? This isn't a loan, so you're not in the senior debt position, but you're above the common limited partner equity. Pref equity usually gets a fixed preferred return somewhere between 8 and 12%, and sometimes there's a little bonus kicker in there as well. The reason this works so well, and the reason that a lot of investors choose to go pref equity instead of common LP equity, is because you have a better position in the capital stack. You are above all of the other LPs, which means you need to make all of your returns before the limited partners make a dime. The cash flow produced by the asset is always going to be prioritized for pref equity holders, and the returns are, although they're fixed, they're actually quite attractive. Now, the upside on pref equity isn't nearly as sweet as being invested as a limited partner into a real estate syndication, where the returns can a lot of times be north of 16 to 20% plus. So yeah, you might be giving up about half the returns, but you also have a lot more security. It's really the sweet spot between security and return, and most investors have never even heard of this before. Now, you might be thinking to yourself, well, why would anyone ever need pref equity? What is the purpose of preferred equity? Well, typically preferred equity is used to plug up holes in the capital stack. Let's say the bank is only willing to lend 60% of the loan to value, and the sponsors have only raised 30% in the equity, thinking that they could get a 70% LTV. So there is a 10% gap there that needs to be filled, and oftentimes pref equity can come in to plug up that hole. Pref equity is perfect for investors who want to prioritize cash flow and risk management. There's not a tremendous amount of upside. There's also not a tremendous amount of equity growth, but it is suitable for investors that are interested in consistent, passive, and reliable cash flow. All right, so now we've gone through private credit. We've gone over preferred equity. Now it's time to go over our third and final passive income investment strategy, which is the triple net sale leaseback. I know what you're probably thinking, Danny, isn't that the name of a yogurt or something? Oikos 000? No. Triple net sale leaseback. Let's break down all three of these words. Triple net simply means a commercial lease where the tenant covers all of the expenses: taxes, insurance, maintenance, everything. A sale leaseback is when an individual or a corporation sells a piece of real estate to, say, us, and when they sell it to us, we are going to then lease it back to them. Not only that, but we're leasing it back to them triple net, meaning they cover all of the expenses: taxes, insurance, maintenance. Now, I know you're probably asking, like, why would a company ever sell a piece of real estate and then just simply lease the building back from the seller? Well, there's many reasons why someone would opt to do this, and there are many companies that actually do this habitually. It is a part of their strategy. They actually build from the ground up, and then once the building is 100% completed to spec how they want it, then they go ahead and they sell that building and lease it back from whoever buys it from them. Not only are there a bunch of tax advantages and incentives for companies to do something like that, but a lot of times they just want the cash to reinvest back into their business. And while they're getting the cash to reinvest, you are getting a predictable stream of income. These tenants are often the best types of tenants. They are super high caliber tenants and sign very long leases, 10, 15, 20 plus years. There are no market swings. It's not like the lease payments or the lease rate is tied to the market. So whether the market is up, down, or flat, the volatility of the lease payments are non-existent. Lots of DSTs, or Delaware Statutory Trusts, take advantage of or buy into triple net sale leasebacks. And we could do a whole nother video video. In fact, I will do a whole nother video on DSTs and Delaware statutory trust. This is a great place to roll in retirement capital. It's also a great way or place to roll in 1031 exchanges. The cash flows on this aren't extraordinary. They're going to be anywhere from 6 to 10% usually. But unlike the other two examples that we gave, this type of investment actually does appreciate, right? So as the building appreciates, you're going to be able to capture some of that upside as the investor. And unlike the other two investment opportunities that we just discussed, you also get a tremendous amount of tax benefits by investing into triple net sale leaseback. There are cost segregation studies that can be done in order to accelerate some of the depreciation schedule that is realized by that building. So ultimately, the triple net sale leaseback is an investment opportunity that is perfect for individuals that want a little bit of both worlds. They want some consistent cash flow somewhere in the 6 to 10% range, and also want to take advantage of the tax benefits that you get by investing into real estate, and also capture some of the upside that's created by the property's appreciation. Okay, so I know what you're probably thinking, Danny, I don't have tens of millions of dollars, and I definitely don't have time to dive into these kinds of investments. And that's the cool thing. You don't need $10 million to start investing into these types of opportunities. You don't need to be a family office, and you definitely don't need to analyze these deals yourself. Through private funds, syndications, and institutional co-investment platforms, you can plug into these same exact strategies, sometimes with as little as $50,000. At Gould Capital, we help high earners just like you access the kinds of passive income opportunities that used to be reserved for the ultra wealthy. Now, joining our community is free, but it is invite only. For starters, you need to be making at least $200,000 per year or have a net worth of at least $1 million. If you fit that criteria, and you're interested in joining our free investor community that gets you access to these kinds of opportunities, you can check the description box down below for a link to my Calendly. You can get on my calendar, have a conversation with me, and together we can decide whether or not you'd be a good fit for our exclusive investor platform. This is Danny Gould, everyone, with Gould Capital, bringing you all the investing secrets, and I will catch all of you in the next video.